welcome back to my channel. So today's video is all about how to read time frames and how to understand the relationship between price and volume to help correlate with entry and exit points when trading. So to start, I have an example of the 1 minute, 5 minute, and 15 minute time frames on the screen, so I'll break down each one. So starting with the 1 minute time frame, this is useful for traders who aim to make decisions on rapid price movements or quick scalps, allowing for fast entries and exits within minutes. Now, this approach is ideal for those who seek to capitalize on rapid market movements. For traders seeking to execute on multiple vantage points in a single session, this is often used in combination with technical indicators like the moving averages or oscillators just to make split-second decisions. Now, I will say this does look a little erratic because the 1 minute time frame, of course, is very small, so it's going to show you lots of detail. Now, within that, there's lots of trading opportunities as well. So moving over to the 5 minute time frame, this provides a balance appealing to day traders who want to take advantage of short-term trends while still allowing for a bit more stability than the 1 minute chart. Now, with this time frame, it reduces what's known as market noise, making it easier to identify clearer support and resistance levels. And traders often look for setups like breakouts or reversals that may last for a few minutes up to a couple of hours with the 5 minute. Now, this one does provide a little less detail, but it also looks a little less erratic, simply because the candlesticks are going to be on a larger time frame. Meanwhile, the 15 minute time frame offers a wider perspective, which is why it looks way smoother, allowing traders to spot longer time trends and patterns. So this time frame is suitable for those who prefer to hold positions a bit longer, potentially integrating it with other technical tools such as like your trend lines, or maybe you want to use your Fibonacci retracement. But by examining the price action over a 15-minute span, you can make more stable decisions about market direction and momentum, which can lead to more strategic entries and exits, and I'll talk about that in just a second. You can also use the 15-minute, even up to the 1 hour periods to spot short-term trends, and this is useful in quite a few different ways. Now keep in mind, there isn't one time frame that's better or preferred over others. In my opinion, they're all equally important, so it's really just a matter of being dependent on what you're looking for and the results you're seeking. Y'all know I've mentioned before that I prefer to trade off the 2 minute time frame, but it's needless to say that I have other charts pulled up over various other time frames to analyze them as well. So it's not like you just stick to one and that's the only thing you do. When you're trading, you usually have multiple time frames pulled up. That way you get full scope and understanding of the charts in totality. So that's why it's necessary to consider combining time frames. You can find a setup on longer time frames and drop to a lower one for exact setup points, and this can lead to bigger reward to risk ratios. Now, these trades are going to be extremely important because when the price nears targets, you can drop to the 1 minute or the 2 minute chart and exit on a reversal if the trade goes against you, and this is to avoid giving back too much of your profits. Now, of course, you want to have a stop loss already set, but you may decide to exit a trade before it reaches that stop loss level, because the value in this is the ability to see chart patterns as well. So on certain time frames, you may not be able to read a specific pattern, but you'll notice on others it's more visible. And I recently made a video discussing that, so I'll leave it linked down below. So next up, I want to discuss the time intervals as far as the analysis for the best time frames for day trading. And this compares different chart times, such as the 1 minute, the 5 minute, 15 that I just discussed. And it highlights how traders can choose based on their trading goals and strategies. So the focus is on understanding the pros and the cons of different time frames to improve your trading efficiency and profitability over time. So we're going to go ahead and take a look at the trading styles. Now, first we see the scalp trades. We also see day trades, swing trades, and leaps. So I'll go ahead and explain each of these. Scalp trading is going to fall under the trading length of being very short, because the holding period for it can be anywhere from 1 minute to a few hours, and then the time frames that it's usually traded off of are the 1 minute to the 15 minute. Now, when we look at day trades, these are going to be short time periods as far as length, because the holding period is going to be anywhere from 1 hour to the end of day, and then the time frames that are usually used are going to be anywhere from 2 minutes to 4 hours. Now, in regards to swing trading, this is going to require a medium term for holding that, and the length of the period can be anywhere from 1 day to a few months or several months out. And the time frames are usually going to be the 1 hour up into the daily, just depending on what you choose. Now, when it comes to leaps, these are going to be long-term trading links that you would hold. And of course, it's going to be anywhere from 1 year out. And it can be analyzed on the 1 day, 1 week, 1 month, or essentially any time frame. Now, the great thing about these is that these short-term strategies, they pretty much focus on those price movements, and it's usually going to be for weekly or monthly expirations, but that's only when it's short-term. Now, long-term strategies involve buying options with longer expiration dates, as I've mentioned before. This can be the 6 months to a year, and it just capitalizes on broader market trends. Now, I do want to provide a bit more detail about this because, again, this is very broad, but I want to get very specific in terms of the details. So to begin, I want to start with the time frame of, let's say, the 1 minute. Let's say we're looking to scalp. This specific time frame offers the smallest, most detailed view of the price action, with each candlestick, of course, representing 1 minute. Now, the chart allows traders to capture many trading opportunities because of the frequent updates, which can result in many trade entries and exits, so you're able to hop in and hop out if you choose to do the 1 minute more rapidly. Now, this view offers market data at a highly detailed level. So instead of looking for broader trends, it focuses on specific price movements and individual transactions on a short time frame. So for example, a trader may look at minute by minute price changes, the volume levels, or even individual order flow to identify patterns and make more precise decisions. This type of analysis is often used in high frequency trading. And this is where even small fluctuations can create profitable opportunities. So I particularly like the 1 minute, but my preference is the 2 minute. So this just helps spot like micro trends or any inefficiencies that are often missed in a broader analysis with this strategy. So some of the pros of the 1 minute or 2 minute time frames is that it offers that high number of opportunities as mentioned. It's highly detailed, capturing every price fluctuation. But a few of the cons are that the high volatility can lead to false movements, and it makes it challenging to accurately project trends. It's also going to be something short-term scalpers who thrive on making quick trades in rapid succession. If they don't have the ability to react quickly, of course, they can get caught up in a trade and they may lose money. So that's going to be some of the pros and the cons for the 1 minute scalping or 2 minute scalping. Now let's take a look if you wanted to do maybe day trades within like the 5 to 10 minute, but it can still be holding for anywhere from an hour to the end of day. Now within analyzing the 5 minute chart, this time frame strikes a balance between detail and stability in my opinion. It's slower than of course the 1 minute or the 2 minute, which allows traders more time to analyze price action, but you're still able to capture the intraday trends effectively. So some of the pros is that it provides steady information without overwhelming a trader with constant fluctuations. It's also suitable for identifying trends without the extreme volatility of a 1 minute chart. Now, a few of the cons are going to be the fewer trading opportunities compared to the 1 minute chart, requiring more patience, of course. And it's also going to be traders who prefer less stress and slightly longer hold terms, but they're still aiming for intraday profits with less frequent trades. So that may be a pro or a con just depending on how you view it. Now, in regards to swing trading, you may look at anywhere from the 1 hour, of course, to like the daily, and this is going to provide longer time frames with fewer fluctuations and a clearer overall view of the market trends. It's much less erratic than the 1 minute and 5 minute, of course, and it makes it so much easier to identify major shifts in the stock's price. Now, the fewer price movements and less volatility makes the chart easier, of course, to see, so you're able to analyze at that full level. With that being said, you're less likely to be impacted by market noise. This offers, again, those clear signals for larger prices as far as how they move up and down. Now, the cons are going to be the fewer trade opportunities because it's making it unsuitable for traders looking at rapid entries that are going to happen right as the market is essentially moving. But it may be ideal for swing traders who have the idea of wanting to have a stress-free trading session, because those quick decisions aren't necessarily 100% needed because it allows you to have a broader market view, which again makes deliberate decision making so much easier. Now with leaps, it's a little bit different because you can view this from so many different standpoints. Because you are viewing it from the point of understanding it's a long-term way of trading, you do have to definitely keep in mind anything that you would see for long-term trends and those strategic ways to capitalize and leverage any type of market motion is going to be something you analyze over time. So the best tips to consider when looking at time intervals are going to be: 1, the fast pace and constant trades mean that the trader must maintain high focus and of course quickly adapt to changes depending upon the time frame you're utilizing. Also, in addition to that, smaller position sizes are typical given any type of range that you choose. However, it requires you to have understanding of any room for strategic plans to change. That way you reduce any type of hectic nature of trading. And of course, you want to slow your pace if it needs to be allowed to do so. That way you can relax between trades. Now again, this is going to be specific to anyone who is choosing for short-term, mid-term, or long-term. These strategies can be applied across multiple time frames. Now, this approach just helps to maximize those trade outcomes as mentioned. And of course, I wanted to pinpoint the precise entry and exit place for those tighter stop losses or those take profit targets. That way you can enter and exit the market just above or below key support levels to make sure, again, you're maximizing profits. Now with that, you also want to refine your strategy to make sure that you're using all the precision necessary so that when you place your trades, you're looking for those swings to either be high or low to protect your overall capital. So next up, I want to discuss the price to volume relationship. You may be wondering what this has to do with time intervals. Well, as mentioned, I want to provide an overview of the best entry and exit points, so this is directly correlating with the time analysis. Because the price to volume relationship in trading reflects how changes in a stock or ETF, how its momentum aligns with its volatility, I wanted to make sure you guys seen this. So on the screen, you see an illustration. So if you were to deeply evaluate a stock, you would see the historical price analysis and the current trend. And within that, you see how strong the trend is. And to break this down, what happens is, when the price rises with high volume, it signals strong buying interest and suggests that the trend might continue. Now conversely, the price increasing on low volume may indicate weak support and a potential reversal because the uptrend is not supported by the volume with enough strength. So it may be a good clue to exit a long position if you happen to be in one. Now, it's not 100% all the time, but for the most part it is. Now, similarly, when the price drops with high volume remaining, this shows strong selling pressure. Therefore, the downtrend isn't supported by volume. And lastly, a decline on price in combination with low volume suggests a lack of conviction from sellers. So you may want to exit a short position because it's showing you that both the price and the volume are low. Now keep in mind that these correlations are dependent upon other factors as well. So it's not just reliant on price and volume only, although these are two very important aspects, but a couple of the other elements to keep an eye on are open interest and implied volatility. And again, along with other things, but I'll say these are the primary focus. And also to mention, a little known secret is that if you ever see a random spike in volume with little to no movement, this may be an indication of accumulation or distribution by large institutional investors, and this sets the stage for a significant price shift. So if you're unaware of what institutional investors are, they're basically just large organizations or like mutual funds, hedge funders, and they invest substantial amounts of money in financial markets. They often have a significant influence on if the price is going to move up or down due to the size of their investment and of course the access that they have to extensive research and resources. So yeah, all in all, the main thing to keep in mind is that volume helps traders assess the strength behind the price movements. And of course, I'll go into more detail as I continue to make these videos and expand on each element. So with that, that'll pretty much do it for this video. If you found the information to be helpful, as always, feel free to leave a comment down below. I thank you so much for watching, and I'll see you in my next one.